sovereign wealth funds, endowments, big mutual funds, and so forth, their allocation to gold is tiny. It's like 1 or 2%. You would think maybe it's 5 to 10%. It's not. 1 to 2% is the right order of magnitude. If they just went from, let's say, 2% to 3%, that's not like a huge move. But just go from 2% to 3%, the amount of dollars involved was so large that, I mean, there's not enough gold in the world at these prices. That's something that would shoot the price even higher. That's starting to happen. It would not surprise me, not even a little bit, to see $10,000 gold before the end of 2026. I think we will. I like to be conservative in my written forecast because, it's good to be right. But $5,000 is within reach. But $10,000 would just come as no surprise for gold. So silver's along for the ride. You at that point you're looking at $200 an ounce. I mean that's not even a stretch. So $200 silver would be in the same vein as gold going to $10,000 an ounce.
The precious metals market is on the verge of a historic supply squeeze that could send prices into the stratosphere. While major institutions like sovereign wealth funds currently hold a tiny 1% to 2% allocation in gold, a minor shift to just 3% would involve so many dollars that there simply isn't enough physical gold available at current prices to meet the demand. As the paper market, made up of futures and options, outnumbers physical supply by roughly 100 to 1, a sudden scramble for physical delivery is creating a high-stakes short squeeze. With gold leading the charge and silver along for the ride, we are entering a period of unprecedented urgency for investors. In this video, financial expert and best-selling author Jim Rickards breaks down why he believes 10,000 gold and 200 silver are not just possibilities, but likely realities by the end of 2026. Rickards explains the fifth-grade math behind why price gains accelerate as they hit higher benchmarks, and why China's historical affinity for silver is a key factor to watch. He warns that the lag between gold and silver has finally caught up, signaling a massive move ahead. But what happens to the global economy when the paper gold market finally breaks? Stay tuned to find out. Let's watch clips from Jim Rickards' explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Well, China actually does like silver. They've been buying enormous amounts of gold. We've talked about that. But historically, China has always treated silver as a precious metal. In fact, until fairly recently, they settled their balance of trade in silver. That's and they like that. So they're part of it. But there's a lot else going on, and we don't know all the facts. But there have been some supply disruptions in the London market, and the lady named Blythe Masters, she was the head of commodities trading for JP Morgan for a very long time. She's moved on to other things now, but she was referring to gold, but it applies to silver. She said, gold never settles. And what she meant by that was, if you look all the paper transactions, forwards, futures, options, unallocated, agreements, settled with banks, the amount of paper gold, but this would be true of silver also, relative to the physical supply, is probably 100 to 1. So as long as everyone's rolling the contracts over, not demanding delivery, etc., the market works fine. But the minute some segment of the market says, you know what, give me the silver, I want physical delivery. All of a sudden, the commodities exchanges and the warehouses, the custodians are saying, well, wait, we don't have that much silver. They have to go get it. I'm not saying there's been a default, but what I'm saying is, all of a sudden, there's a scramble on the physical side to keep up with the paper side. You can never keep up with the paper side. It's way too big. So then you get into the dynamics of a short squeeze. So that's driving it. But I've said all along, if gold's going where I expect, and I've given a forecast to my readers in my newsletter, Strategic Intelligence, of $5,000 by the end of 26. I called my editor the other day and I said, we have to publish quickly because I'm going to hit that before we publish the forecast. It would not surprise me, not even a little bit, to see $10,000 gold before the end of 2026. I think we will. I like to be conservative in my written forecast because, it's good to be right. But $5,000 is within reach, but $10,000 would just come as no surprise for gold. And there's kind of like a fifth grade math issue here. It's not complicated, but so people think of the dollar price, $100 an ounce for $1,000 an ounce. And let's say you have 50 ounces and gold goes up $1,000 an ounce. Well, you just made $50,000. And if it goes up another $1,000 an ounce, you just made another $50,000. So that's true. But people get anchored on the $1,000 benchmark and making $50,000. But what they forget is that each $1,000 benchmark is easier than the one before because you're working off a higher base and it's a smaller percentage. And just to give a concrete example, when you go from $3,000 to $4,000 an ounce, that's a 33% gain. But when you go from $9,000 to $10,000 an ounce, that's only 11%. That's like a good week the way gold's been going. So my point is, you're like, hey, it took a really long time to get from 3,000 to 4,000, which is true. But so therefore it's going to take forever to get to 10,000. That's not true because it'll make its way to 5 or 6, but it's going to go 7, 8, 9, 10 really quickly. So silver's along for the ride. You at that point you're looking at $200 an ounce. I mean that's not even a stretch. The people talk about the gold to silver ratio. You can calculate it. It's just a number. There is no fixed ratio. This goes back to some 19th century lobbying campaign by silver miners. People talk about 16 to 1. That was a political lobbying thing. There's nothing natural about it. Having said that, there's no way gold's going to where we're talking about $5,000 to $10,000 an ounce. The silver's not going to move also, which it will. So $200 silver would be in the same vein as gold going to to $10,000 an ounce. Silver lags. I mean, gold will lead the way, but silver's along for the ride. But it does lag. But now the lag has caught up, and silver's taken on a life of its own.
Building on the momentum of the current rally, the focus is shifting toward the structural forces that make this market different from past cycles. Analyst Jim Rickards emphasizes that while the Federal Reserve often dominates headlines, its influence on monetary policy is becoming increasingly irrelevant compared to deep fundamental drivers. Central banks have moved from net sellers to aggressive net buyers, effectively placing a floor under the market by purchasing dips to diversify away from U.S. Treasury risks. Meanwhile, the BRICS nations are not just talking about de-dollarization, they have built a sophisticated independent payment system that settles bilateral trade balances in gold. As physical supply remains flat against this exploding demand, Rickards warns that we are witnessing the first act of a global financial reset. Could this movement toward a gold-backed settlement system be the final nail in the coffin for dollar dominance? Now, let's watch some more clips from his interview.
The Fed is practically irrelevant in a lot of ways, not just the price of gold, but in terms of monetary policy and so forth. We don't have time to do a deep dive on the Fed, maybe some future show. But yeah, you're right. That's just some Bloomberg writer trying to get through the day. The Fed has nothing to do with it. There are drivers of gold. There are fundamental drivers. Now, some of this is momentum. It gets going and people jump in, but we're not at the crazy, momentum stage where, it's a retail outlet. People were lined up around the block. I mean, some places, but we're not there yet. But there are some really deep fundamental things driving gold. One of them we've talked about before. Central banks are net buyers. That tipping point transition that was in 2010. From 1970 to 2010, central banks were net sellers. Since then, they've been net buyers, but the number of central banks joining in and the amount of net buying has continued to increase. So that's just a good fundamental driver. And it's important for investors because central banks are actually pretty smart buyers. They mess up other things, but they're pretty good when it comes to buying gold. They don't chase the price, but they kind of put a floor under it. No guarantees, but they buy the dips, to use a cliche. Russia's a good example. They're very transparent. They would just put in a standing order. 10 tons a month or whatever. They didn't want to disrupt the market. But if they see a dip, they'll buy it. So you've got it's great for investors because you have all the upside. But the downside is kind of limited because the central banks will step in. So that's number one. Number two, good old-fashioned supply and demand. The supply has been flat for 7 years, around 4,000 metric tons a year, up a little bit, down a little bit. I'm not saying peak gold or gold output. There are no more gold mines that are out there, although they are getting harder to find and more expensive to mine. But demand keeps going up. So at least where I went to school, demand goes up and supply is flat. The price goes up. That's how you make the market work. Institutional investors are dipping their toe in the water. And the thing to understand about institutional investors, now I'm talking about sovereign wealth funds, endowments, big mutual funds and so forth. Their allocation to gold is tiny. It's like 1 or 2%. You would think maybe it's 5 to 10%. It's not. 1 to 2% is the right order of magnitude. If they just went from, let's say, 2% to 3%, that's not like a huge move, but just go from 2% to 3%, the amount of dollars involved was so large that, I mean, there's not enough gold in the world at these prices. That's something that would shoot the price even higher. That's starting to happen. Well, if you're Saudi Arabia or Japan or Taiwan or Brazil or any large holder of U.S. Treasury securities, you're looking at that and saying, hey, what if the U.S. doesn't like something I do? What if I'm on the blacklist someday? Maybe I ought to diversify into gold, and they're doing that. So you have, again, I'm not saying they're dumping treasuries. That narrative is not true. But as new reserves come in, they are buying more gold. So these are really fundamental things that are pushing the price up, and they're going to keep it there. As far as I can tell, that the unit is it might be real, but it's not the BRICS. It's not official. I mean, some crypto promoter is behind it,
Yeah.
and maybe you can go buy one, but that's not the official BRICS currency. Now, what the BRICS are doing, they're not launching a BRICS currency, but they have built a BRICS payment system. That part is true. So the pipelines, the fiber optic and high-speed digital connections, settlement, clearance, message traffic, the SWIFT equivalent, they have built all of that, and they are rolling it out. They're basically leaving SWIFT and FedWire and New York Clearinghouse. They're leaving all that behind. They're building their own systems. Now, these are communication systems. They're ledgers, settlement. It could be blockchain-based, but blockchain has been around since the 80s. That doesn't make it, crypto per se. So they built the infrastructure. Now, you can have bilateral trade between Russia and China. I mean, I think BRICS are now up to like 11 or 12 members, but there's a waiting list of 17 countries. They're growing pretty quickly. So you can have all this bilateral trade going on. So let's say Russia's buying manufactured goods and semiconductors from China. China's buying oil and natural gas from Russia. So Russia pays in yuan and China pays in rubles. And the central banks are building up these balances that do have to be settled up periodically. They don't have a common currency. So how do you do that settlement? I mean, Russia is going to be up to their eyeballs in yuan if China keeps paying them in yuan. How much do you really need? The answer is they do have a common currency. It's gold. It's not the unit. It's not a new BRICS currency. It's gold, because gold is, ironically, you can convert it into dollars, in real time.
We are not just looking at a price rally, we are witnessing a fundamental reassessment of the global financial system. As the gap between paper claims and physical reality widens, Jim Rickards urges investors to act before the window of opportunity closes. He recommends a 10% allocation to physical gold as a permanent safeguard to protect your purchasing power when the paper market inevitably fails. Don't wait for the mainstream headlines to catch up. By then, the physical supply may already be gone. This is the time to secure your wealth in an asset with zero counterparty risk. Are you prepared to hold your ground when the dollar's dominance finally fades? Share your thoughts in the comment section below. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.